Well, hello, everybody. It is November 19th. And today I'm going to talk to you about a pretty boring update, but I think it's really important and why boring is actually better. So let's go ahead and get started. My name is Stephen Meade with Domicile real estate for people who love houses. This is our Southern California housing market update, and it is a boring one, but boring is better, and I'm going to tell you why. So before we go ahead and get into everything and start showing the slides, this market has been a roller coaster the last 4 years, 4.5 years or so, really since the beginning of the pandemic. And you might think that a roller coaster market is fun and exciting, but I can tell you, if you are a seller who's had to sell maybe in the last few months, right, or in the last year, or if you're a buyer who has at numerous points along this path had to be a buyer in this market, or maybe you were a seller and a buyer, right? So you saw both sides of it. Believe it or not, these kind of highly volatile, sort of crazy market dynamic markets really take a big toll on buyers and sellers alike. I think it's very easy to say, wow, sellers had it really good. But again, just think of yourself. If you're a seller and you were selling something and had to buy something else, was that really a great position to be in? And we're finally seeing some signs that we're really settling into what's more of a normal rhythm with normal relationships between supply and demand. And I really think that that's a benefit to everybody in this market in the long run. It's not just something that's good for sellers or just something that is good for buyers. So let's go ahead and jump into it right now. So if we go with our total active listings, right, I think this is always the great place that we like to start because it gives us a good comparison point to last year. So we're still at a point where we have higher inventory than we had at this point last year, just in the total numbers of houses. So, last year we were right around 5,000 single family homes under $1 million. This year we are right at about 77,000 or so. So if you go from 5,000 to 7,000, I mean, that's a roughly 40% increase in the number of homes available versus this point last year. 1 to 2 million, things are a little bit tighter than they were last year. I think we were a little over 3,000, and now we're a little over 4,000. So maybe more like a 25% increase on that. So definitely a change from last year, really sort of an improvement, but these are still sort of below normal numbers, right? Below pre-pandemic numbers, but they're still much better and in a better direction. I think it's interesting that while we're seeing that 1 to 2 million category fall, we're not quite seeing the same fall in active inventory under $1 million. So if we look at, over the last 14 days, new listings, right? Like where are we today? We are I think just a little bit over or just a little bit under 2 weeks since the election. We really saw a big drop off happen. Now, if you look at where we were at last year, you'll notice that sort of this period through the end of the year really is just a period of declining new listings coming on the market. And by the way, that's normal. We often talk about California as not being a seasonal market. While it is not nearly as seasonal as the snow belt markets, we still definitely have a seasonality here in California. One of the things I think that is interesting, though, is you see a rebound in the number of listings, albeit a small one. We're still at a lower rate, under $1 million, and you see a flattening for that 1 to 2 million, which I think is pretty interesting. I think some of that might be a little bit of sort of pent up demand. People were holding off pre-election. We always see that in election years. It kind of shifts things towards the end of the year a little bit. If we look here, though, at our new escrows, what we don't see is a huge rebound on that front. Instead, it's rather more of a gentle decline. Now, admittedly, for both of these, under $1 million and 1 to 2 million, we're still kind of in that window that we've been all year, right? So they haven't fallen off the way you would normally expect them to fall off towards the end of the year. But one thing you'll notice that I've always found interesting about our market seasonality is that while the number of listings on the market does tend to fall off, the number of buyers falls off by a lower amount. It doesn't crater nearly as hard. And I think that's a function of sellers don't want to move, but buyers who might be in an apartment are not necessarily against it. Now, if we look at our absorption rate, that's one area that's really still pretty healthy. I mean, we've been trading in a similar range all year. Is it as strong as it was in the beginning part of that year through that February and March period? No, but it's not really that far off from those either. And in fact, it's really stronger than it's been all summer long, which I think is interesting. So it does mean that we are seeing a pretty decent relationship between supply and demand. Now, if we look at our three-way chart of closed prices, right? I think, again, I have to preface this by saying this is looking 4 to 6 weeks in the past. This is a trailing measurement. It is telling you where the market was 4 to 6 weeks ago, not necessarily where the market is. And I think it's interesting that you do see some upticks on both that entry level 25th percentile and that median. We see a little bit of weakness on that 75th percentile, but honestly, there's kind of a lot of gyrations going back and forth. I'm not sure that isn't just noise in the signal, because even that number that is there is still a bit of a recovery from where it was in the months in the past. I think we definitely did see our market pick up a little bit as we kind of went through that October timeframe. And again, this is a normal market for us. Normally, August and September are slow, and October is honestly usually a better month in terms of demand and buyers being out there. If we look at our percent still active after 14 days in the market, this is really trading in that same range we've been seeing since May. So not anything terribly remarkable here. This is another measure of market competitiveness. In fact, I would say it's a little more competitive, especially in those $1 to $2 million houses than it's been the last few months. And again, I think that anecdotally makes sense with what we're seeing out there in the market. Now, if we look at our close to list ratio, this is one that I think is a really interesting graph, because pretty much for the first time since January, really, of this year, we're seeing that 1 to 2 million. We're actually seeing that close to list ratio. We're seeing it below 100%. And we're seeing that under $1 million mark treading really close to 100%. So I'm going to tell everyone on here, and sellers, please do pay attention to this, something that I think nobody, especially if you're a seller, wants to hear. But the reality is, over list price sales as being the average sale being over list price, that's not normal. Normally, we generally see things in that 98 to 100% range. So normally we're a little bit under 100% for the average price being, and where that is in relation to its list price. So definitely understand that while this might look like a little bit of a scary graph, we're technically still above what I would consider a normal market, but we're moving more towards that normal market. Days on market for new contracts, big surprise, 1 to 2 million, that is going up. Under 1 million is kind of holding steady, but it had risen a bit as well. But I do want you to look back, if you can, towards where we were on the left side of this graph last year. Days on market always shoots up as we head towards the end of the year. This is nothing unusual or nothing really to worry about. It's one of those things, it's just kind of one of those things that happens. And in fact, we're actually shooting up, especially in that 1 to 2 million, a little less than we had shot up last year. So it'll be interesting to see where we end the year, where that peak number is. You'll notice if you're looking last year, peak was just under 50 days, and about for our 1 to 2 million, and peak was 40 days for that under 1 million. It'll be interesting to see where we kind of end this year. And then we have our other three-way graph. This is sort of our payment index, our rent index, and our CPI index here. So if you look at our rent index, this is about two sort of graph spaces apart. And you'll see that's really where we've been maintaining for a good portion of this year. When the rates fell a bit, you see that payment index came down quite a bit, and those numbers got close together. And what did I say was going to happen? That there was some room for them to go apart, and that is exactly what's happened. Not reflected here in this payment index, but I think something important is that we are seeing a little bit of easing today on the mortgage markets. I don't know if that trend's going to continue. I do think the bond market, obviously, as soon as they started to believe we were going to be heading into a Trump administration, the bond market actually did the opposite of a rally. It got a little worse. They were expecting more economic growth and more inflation, which tends to push interest rates up. I think that bond market is tempering a little bit, and we're just going to have to stay tuned through the end of the year to see where we end up. And finally, we've got our prevailing mortgage rates. You see they dropped right there to just kissing 6% and then kind of coming back up to the high sixes and leveling off. I really would like to see us get to a number that is around that 6% mark again, but I can't tell you when I think that is going to happen. And, speaking of talking about things that happen and what we're expecting for next year, there are so many things, macroeconomic factors that could face kind of seismic shifts based on government public policy decisions. Um, Widespread implementation of tariffs, mass deportation of a workforce when we already have unemployment really low, government spending, reduction of government spending, right? Like, even if there are tax cuts, but we see spending drop in a wholesale manner, that could also have these will all have sort of effects and push on that inflationary lever and expectations about future inflation, which is really what determines mortgage rates out there in the market. So I think it's way too soon to tell and give any kind of predictions on where we are. I think if anybody's really kind of peddling you that with any level of certainty, they are taking guesses in the dark, because any one of these factors could significantly upset some of those forecasts, depending on how those policy decisions come to pass. Anyhow, that's all I've got for you. Thank you so much for watching. Questions and comments, we love them. Don't forget to like, subscribe, and hit that notification bell. And as always, if you or someone you know could benefit from our expertise in the Southern California real estate market, we would love to work to represent your interests. Definitely reach out to us via the contact methods below, and we'll see you again real soon.